First of all, for those of you still in the room, thank you so much for staying with us. And what is actually the time of day when I know that you would normally be having your second cup of coffee. Not only do you not have that, you also, as Randa mentioned, have no water. So I really appreciate your continued support in this room. So I'm so excited to be here. I am so excited that the SEC is doing this. I am so thrilled to be a moderator for this amazing group of people who you're going to hear from. The only real thing that I asked my panelists to do, obviously, besides being prepared, which I knew what they were going to be, is that we are not all going to agree. That's what I just told them, because that is a reflection of how people feel about this disclosure and how they view this disclosure. So that is a perspective that we're all going to bring to the table. So just to level set, we're going to do three things on this panel. First of all, because we're at the end of the day, we've had the benefit of hearing from the first two panels. So we're each going to get to say something about what the other two panels spoke about. The second thing we're going to do is dive into some of the tables, the summary comp table and the other table. And the third thing we're going to do is talk about the Dodd-Frank rulemaking. So that's sort of our mandate for today. I am actually going to start with the other side at the end and start with Mark on what is the one topic or discussion from a prior panel that you'd like to add your views on and then go down the road.
I guess I am going to take it from the other direction, which is what have I not heard so far? And I'm sure I'm wrong. I'm sure I may have missed one, but I thought I was paying pretty close attention. I have not heard anyone talk about valuing, buying, or selling a security based on what we talked about today so far for over 4 hours, I think, give or take. And I don't think many people noticed that. And there's a reason for that. And that is compensation is distracting. It is interesting. It's accessible. And it's salacious, right? Like we talk about Andy Reid's compensation not because we think it affects whether the team's going to win or not. We talk about Tom Cruise's compensation not because we're like, hey, that must be a great movie because he got paid so much. Or he got paid too much, the movie was bad. We're just interested in his pay. And so you have this thing that is interesting. And then we heard that it is complicated, right? We heard from Deborah this morning. Right, she's like, look, the board's responsible for compensation, but it's so complicated, the board doesn't do it. The committee does it. And it's so complicated, the committee doesn't do it once, it does it more than like every other month, right? It probably meets close to every month. And it's so complicated that that's not even enough. We have a person in management responsible for helping us. We have advisors responsible for helping us. Lawyers got short thrift. But it is super complicated. And so you take this thing that is captivating, and then you take it and it's complicated, and you're like, complicated isn't exactly what complicated business decisions is not what shareholders are supposed to be involved in. Like we have a separation. We have management that works day to day, we have boards that work part-time, and we have investors who do their day jobs and let boards take care of it. And they have important decisions to make. And so including buying, selling, or directors, like those are important decisions. We can all agree on that. So what brings this sort of toxic couple together of captivating but complicated? Or Selena and Justin, so to speak. And that is Say on Pay. Say on Pay brought it together. And from that perspective, it has had tangible results. It's our import, right? Like we didn't invent it here in America. Like we brought it over from the UK because we were mad. Like we were mad at the financial crisis, mad at people getting paid and leading failing institutions. We were mad. And so we brought it over, and its first purpose was to reduce excessive pay. I don't believe anyone thinks it did that. It has had other impacts. We have lots of disclosure in the system now. Right? We have more disclosure in proxies about pay than about directors. I tested that. We have separate teams at investors to think about compensation. We have a whole new set of people to think about this. That's additional cost. We have advisors on all sides, including proxy advisors. That's another set of costs. And so I think, when I approach what we're going to be talking about, which is the disclosure, it needs to be in the context of something. It's mandated, and I hope that Congress is thinking about this when they think about proxy advisors, because part of the reason that they're so influential is because we're talking about this thing that is so captivating and complicated. And if we didn't have that, their influence would be less, and there would be fewer choices to make. But disclosure, if we're going to do it in this context, it needs to be as simple as possible. It needs to be as limited as possible and as uninteresting as possible, so that it does not overtake everything else. And I was looking the other day, and this is from an article by Professor Gordon. I don't even know when exactly it was written, but I found it so prescient I had to bring it into us. And it was right before we imported Say on Pay from the UK, and he's like, hey, the UK experience hasn't been so great, and he said, but that's not in reducing pay. He's like, but that's not really the most serious concern. And this is in a summary because that's all I read. The most serious concern is the likely evolution of a best compensation practices regime, which would embed normatively opinionated practices that would ill-suit many firms. There is some evidence of an UK evolution in that direction. This problem might be more pronounced in the US because US shareholders are even more likely than their UK counterparts to delegate judgment over compensation practices to a small number of proxy advisors who themselves will be economizing on analysis.
So I just want to, as moderator, I get to jump in and comment on what everybody else says. So it's sort of moderator/commenter, just in case you weren't aware. But I want to emphasize two things that Mark said. One is the fact that the proxy has more disclosure about comp than directors, than the board. That suggests that maybe we may need a reset there. And the second is every time people talk about Say on Pay, the benefits of Say on Pay, it's about engagement. So John, I am actually going to ask you how many companies you actually engage with before you answer the other question, because it is not possible for you to engage with every company. And by the way, if the purpose of Say on Pay is engagement, I am sure we can figure out some other way to do that.
Yeah, so on an annual basis globally, we have about 3,300 engagements with companies. And for us, an engagement is a one-to-one meeting with directors or senior company executives where we're exchanging information. It's not sending an email. It's not a letter writing campaign. But 3,300 companies. Those engagements cover about 75% of our clients' assets under management, but it only covers about a quarter of the companies in which our clients are invested.
And you have a whole team of people for that purpose. So,
correct.
Going back to John, what is the one point you'd like to make?
There was a comment made in the first panel about the forest and the trees, and that really struck home to me, especially as we're launching into a conversation around the tables and what the tables convey. As an investor, the questions that we're trying to answer when we're looking at the efficacy of compensation committee directors or the appropriateness of a Say on Pay vote, they're simple questions. It starts with a question of, knowing that compensation is a tool that the board employs, has the board has the compensation committee structured compensation so that it supports the execution of company strategy, so that it reinforces the culture of the business. And is it doing that in an efficient way? Efficient in terms of complexity, efficient in terms of quantum, all of those things. And when you break that question down, there's a couple sub-questions that go below it. The first is quite an easy one. It's a mechanical one. How is a compensation program structured? How much is long-term? How much is short-term? How much is cash? How much is equity? How much is performance-based versus how much is time-based? There's no table in the proxy that tells you that. There's no standard disclosure that helps you understand that. You have to flip back and forth between tables and put that answer together yourself. And that's a fundamental question of disclosure that we look at when we're trying to understand a compensation program. Second, we're trying to look at how much risk is there in a compensation program, and risk is defined in a lot of ways. But again, there's no single table that tells you that. There's the grant plan-based awards table that tells you how much leverage is in a program. There's the summary compensation table, which tells you how much is delivered in guaranteed cash versus other forms. But all of those are incomplete disclosures. And trying to get to something that is more helpful at answering that fundamental question would be helpful. But then third, and maybe most important over time, is how effective are these compensation programs? How do they turn out over time? That turns out to be a very, very difficult thing to answer. So trying to answer that question through the disclosure, we focus on a lot of trees, but the forest for us at the end of the day is, do these things actually work? Do they turn out like we want them to? And I think we're going to be talking a lot more about that over the next hour or so.
Ron?
Sure. I may focus a little bit on trees for a second. I think the thing that I was taking away from both of the panels before is really just how complex some of the issues we're dealing with are. And you can really make them more complex by drilling down into them. And I think by doing that, you, again, might be focusing too much on the trees and not the forest. And so the goal here is to say, how can we step back and make this disclosure regime better and more effective for all the users. My tree focus on that is going to be perks. Perks is the most salacious of the salacious pieces. Are they getting to fly around in the private jet? What kind of jet is it? You can now have people follow the corporate jets on Instagram and everything. I think that this is an area where the SEC, when they are looking at the treatment of perks, actually have a lot of flexibility. And that's because, Mark mentioned this earlier, that the rules don't actually define what a perk is. It's all just in this 2006 release that was kind of narrative by the commission, and the commission, I think, could quickly revisit that. Again, it's going to be a complicated revision because it really should be, and it was described as, a facts and circumstance determination, but then there were other parts of that 2006 release that said, kind of went against that and said, no, these are areas where certain benefits are perquisites, and almost drew a bright line. And I think as we're talking about executive compensation, there's really not bright lines. It's the area where principles do matter, principles could work, and the more we kind of build a system that lets companies appropriately disclose what is working for them and what they have designed, the better it's going to be for both the companies and the investors.
So I spoke with each panelist before we all got together as a group, and I had a really interesting conversation with how Drew has looked at proxies for years and years. I won't say how many. So Drew, what's your view on what you've heard so far?
Great. And can I start disagreeing right off the bat? Good, okay.
Absolutely, I would count on it.
Yes. Well, I'm going to start out with something I heard earlier, and I would, in full agreement with everybody, that the complexity and the pagination has gotten out of control. So on my way down today, I took a typical 40-page CDNA. I read it front to cover. I don't usually do that anymore because I know the elements I'm looking for. In this particular one, I saw the same graphic twice in the 40 pages. I saw the same paragraph 3 times in the 40 pages. And in one of the paragraphs, that was only 4 sentences long, the company used the word robust 3 times. So I'm going to offend some lawyers and some comp consultants today. We need more copy editors and less consultants, because I think most of your proxies I could cut 25% off with a good copy editor. So I want to touch on something Ola Petter said earlier. There is nothing in the rules and regulations that says we have to set up compensation programs that require a slide rule and an abacus to figure out how somebody's going to get paid. And that's what we have done. We have gotten to this place where the plans are so complex, the instruments we are using are complex and opaque and not disclosed as well, and there's nothing in the regulations that said we had to do this. So we need to get off the treadmill, and investors and the companies we own need to talk to each other and come up with more sensible, simpler plans. Now, in terms of where I'm going to disagree with Mark a little bit. Not so much disagree. Yes, we do not use executive comp to make buy-sell decisions, but let's talk about how some of our portfolios are constructed. If you're a large asset owner, like the one I represent, we use a lot of indexing. In essence, we're going to own some of these companies for a very, very long period of time. And I know some other asset owners in the room do that similarly. We do so because it's cost effective. We're trying to get market exposure. And so, yes, we're not making buy-sell decisions on any of ours, but we own the market, and we should have a voice on how those people that we've entrusted with that capital, both directors and CEOs, pay themselves and oversee that. And that's just a market reality of how people invest. We own over 6,000 companies in our portfolio, and I see some others in the room, and John talked about how many they own and the index products that they are selling. This is how the market is invested a great portion. We don't just go out and buy our 3 or 5 favorite companies. Most people, both retail and investors, have some sort of indexing in their portfolios. So yes, it's not a buy-sell decision, but it's an important decision for long-term holders who will hold this equity through the cycle, that we have a voice on this.
So, Drew, I will tell you, I completely agree with you that we should cut out repetition. I can tell you where some of that started. And where some of it started is because we heard from investors that they don't read the whole thing. And so they started asking for summaries. And when they started asking for summaries, we started taking certain things that were in the CDNA, putting in the summaries. Then they told us they don't always read CDNA. They might read footnotes to certain tables. So then we had to put certain things there. So some of the repetition, if I could get all the investors, not just in this room, but otherwise, to say, just put it anywhere once, we will figure it out. We don't expect it to be in multiple places. We will read it. We will cut the repetition. I will work on the issuers if you work on the investors. That's a deal.
Agreed.
So Sarah, you're not the only issuer in the table, and then not just because I advise issuers, but back when I actually did this comp disclosure as an in-house lawyer in 2006, back when it started. I was only 12 years old then, but so I can emphasize with this. But as the in-house lawyer, what is the one topic or discussion that you heard that you'd like to comment on so far today?
Well, Ning, I'm going to be a little naughty. I've got 2. I'm going to break with precedent, but I promise to be brief. So the first, one for each panel. So in the first panel, I really thought the way in which they framed decision-making around executive compensation was really useful. Because I think sometimes we forget that executive compensation disclosure does not exist in a closed ecosystem. It exists in the context of corporate governance regulation that already imposes requirements around how companies function at the board level and to a degree at the management level around key decisions, including with respect to compensation. And so I felt the way that that panel outlined how decision-making is undertaken was really useful. I think to a degree, the amount of complexity we now have goes counter, I would say, in some regards, to the dependence on independent directors and how they function in that governance regime. And then two, from the second panel, I really loved Zach's Venn diagram. I thought it was simple and elegant. The idea that this lies kind of at the nexus of board considerations, investor needs, and internal resources and capabilities. I think the issue we have now is that the regime we have now results in kind of bad results on all three, from all three circles. When we look at board considerations, I think the current regime can distort decision-making. I think when we look at investor needs, I understand we have very sophisticated investors in the room. Not all investors are at the same level, and the results can be confusing. The questions that issuers receive make it clear that it can be confusing. And then when we look at internal resources and capabilities, I think we have a futility of effort sometimes to produce disclosures that either don't get read or do confuse investors.
Terry?
So I'm going to use my voice today to talk a little bit about the pay versus performance rules. And that's one of those rules that's really been under attack over the last couple of years. And I'll start with, and I'll say they're flawed. And they're flawed because they're misunderstood. They're flawed because investors don't use them. They're flawed because it doesn't exactly get us the number, ultimately, that we need to get at. Now, I'm going to back up from that preface of saying they're flawed and say that theoretically, it's a very fundamentally pure number. There's fundamentally a very pure number that's better than anything that you can find out there, better than any of the proxy advisor calculations. Maybe I'll quickly get into the granularity of why that is a fundamentally pure number, but it's based off of audited financials. There were a few decisions made in that calculation that the SEC made years ago. The first decision is, when is the measurement date for this compensation actually paid, this realizable pay calculation? And what that decision, that answer was made then, was the vesting date. The vesting date is when it transfers from a compensation decision to an investment decision. The second decision that needs to be made in that calculation is, do we calculate this on the vesting date as an intrinsic value, just the difference between the stock price and the strike price, or on a fair value? And the decision that was made is to do it under a fair value basis, like the accounting standards. And I agree with that decision because I think it has to be on a fair value basis. So ultimately, that calculation, I think, is very fundamentally pure. It's audited. It's pure. And then lastly, the last big decision is, now we've just calculated a multi-year instrument, a 3-year or 4-year instrument of what that value is on this vesting date. But it has to be annualized to compare to annual performance measures. And what the SEC has chosen to do in that decision, again, I think is a positive. Just take the end of year minus the beginning of year. So they made these decisions, and I think they come up with a very fundamentally pure calculation. But then there was another flaw. Unfortunately, they put this 5 years of disclosures that need to be done on this calculation, but there's a dependency year over year over year. The prior year, the next year, is dependent on where the last year ended because it's an incremental growth. So any single year is meaningless by itself. The only way to really analyze this is through a summation of all the years. The sum of the compensation actually paid versus the sum of the summary comp table number. So that was a flaw. So there's fundamental flaws in this disclosure that has hurt it. And I think that is why investors aren't paying attention to it, because I think it's a great number. It's very easy, especially with the XBRL tagging, to take those numbers, the sum of the summary comp table. What does the sum of the summary comp table represent? It's the market rate of pay. It's how much a comp committee was trying to pay an individual over that 5-year period. What should an investor expect, Drew? What should an investor expect for the market rate of pay? Market returns. What do market returns represent? Well, luckily, right there in this table are market returns, because you're forced to pick a peer group TSR, and it's disclosed right there. If your peer group TSR is greater than your own TSR, if your own TSR is greater than the peers, you should get paid more than the market rate of pay. If your TSR is less than the peer group TSR, you should get paid less. It's really quick and easy to do alignment, especially with XBRL tagging. It can be done very quickly. 25% of companies are misaligned that way. It's a fundamentally pure calculation, but no investors are paying attention to it. It is a tree that has fallen and nobody heard.
So we're going to come back to the pay versus performance table at the end, as I told you, everyone, that we're going to talk about the Dodd-Frank rulemaking. Before we leave this component of our discussion, I will just add my 2 cents that exec comp disclosure poses a bit of an existential crisis for a securities lawyer, because there is nothing I have ever learned about security law that actually fits this framework, in which we're supposed to tell investors about every single piece and every single dollar and every single component. We don't do that with major businesses. We don't do that with massive capital decisions. We don't do that in the 10K, which drives investment decision. But for some reason, this is the area where we are supposed to somehow get to the pennies and cents. And it's a little bit of a really unusual work for a securities lawyer to kind of mind meld with that. And then when we get to being governance lawyer and we talk about our board, it is not measured on dollars and cents. It is measured on multiple qualitative aspects that we expect investors to understand, and I think most of them do, or they will ask. So it is a little bit of a really how do we get here where we're spending all this time and on the little dollars and cents that Ani pointed out that we're spending on executive security as an overall. And so with that, I'm going to turn to the summary comp table where this will tie in. So the summary comp table, if you look at the various components, right, salary, bonus, stock awards, option awards, non-equity exec comp, change in pension value, non-qualified deferred comp, all other. Somebody said, well, if you were an alien, you came in red proxy. You don't need to be an alien to realize that you're just jumbling up a bunch of stuff and putting it together and expecting the total to mean something. And so I'll fundamentally turn to you, Sarah, to talk about what maybe we should really start with. Is this material?
Thanks for the easy softball questioning. So Mark actually set me up really well for this, so thank you for that. Thank you for that, Mark. I think the question of materiality, it's a question that has to be asked in the context of a specific voting or investment decision. And I think there's such a diversity of not only disclosure out there, but companies making that disclosure. I think there is a fair argument, however, that in many situations, the majority of information contained in the summary compensation table is unlikely to be material information. That being said, I'm willing to concede that portions of the summary compensation table may provide useful information to investors in how they're thinking about their voting decisions. And portions likely provide less useful or even potentially misleading information, which I think is some of what you were getting to, Ning, and I know we'll flush a lot of that out in the other questions in the panel. But I do think perhaps bigger questions we could ask is whether or not the summary compensation table provides useful information to investors that isn't otherwise provided. Or that couldn't be provided in a more useful and accessible manner.
And Ron, tell us what the total means.
Yeah, well, I agree with you that the total is a mixture of different elements. And if you think about it in the context of what we've heard today, on the one hand, Brandon said, well, we rely on this information, but that's because there's not another total out there. And the other information that both the that investors, that we're hearing some of these investors say they want, and that I hear from investors, is not readily available. So again, I think the opportunity here is to step back and say, how can we improve this? But the total definitely needs to be focused on. It's obtained outsized importance. It's what media starts with. You heard earlier that the reason companies are hesitant to provide security that's needed is not because they want to avoid the disclosure, but because it's going into that total column. And when you think about how this whole set of rules is kind of built around that total column, even the executives that appear in the executive compensation tables is driven by that total column. And once you kind of step back and say, no, wait a second, does that really accommodate different types of arrangements, or is it part of the problem? I think it's part of the problem. I'll give one quick example, is that if you're granting compensation that equity awards that vest over a long-term period, like we've heard some people talk about, and you're comparing that with an equity award that vests over 3 years, you're going to have a larger amount there in that total column, even though the actual compensation that person is receiving may not vary from what the person that had the 3-year award received. I think kind of amazingly, even Congress recognized this. They in Pay versus Performance came up with this concept of compensation actually paid. And as David said earlier, that's reflecting the fact that the total amount is not what is paid. It's not what we heard on the first panel that the committees are looking at. And if you look at the CD&As, where people are really trying to explain their programs to the investors, there's no explanation of the total column. What you see is a discussion of total target direct compensation, total realizable compensation, and sometimes you see discussions of total realized compensation. But even that, you don't get a whole lot because the tables don't flesh that information out.
And we're going to get to realizable comp and realized comp at the end of this component discussion. But first, I'm going to turn to Mark to talk about a little bit more about the different elements of the summary comp table. We heard from panel one, and I think it was very important that panel one led with, well, how are decisions made? Because that is the starting point. So in an ideal world, the disclosure should somehow, and that this is what we're all here for, is to try to figure out how, reflect how those decisions are made. Does the summary comp table do that? I'm trying to ask that sincerely. Is it inconsistent with how the companies think about decision making, either in the elements, or we get another shot at talking about the people in the summary comp table? And I would also throw in the time frame. So it's really 3 things: the various components, the people, and then the time frame, the 3 years.
So I'm not going to take up a disproportionate amount of time. We did have a comment on this about 10 years ago, and there's a link to it in the announcement of the roundtable and the panels. And the premise is that the summary compensation table was a new invention. It's new. Everything was dollarized for the first time. Also, the instruments that you were talking about were different instruments. We had PSUs, which everyone agrees is very complicated, but that was a small piece of compensation at the time. The table was invented. Options was the largest piece, actually, which you don't really see anymore. And so what you end up, from my perspective, in that summary compensation table is it's not even just apples and oranges. I guess it's like a fruit salad. It's like a fruit salad. And the reason is on 2 dimensions. You include compensation at target and compensation as it's been determined. So bonuses, cash bonuses, are what's the actual outcome? And so that's the actual outcome. Equity is, what's the target? And so you're comparing actual outcomes and targets, and you're adding them together, and you're getting sort of an odd number, particularly when the thing that is at target is the biggest thing in the table. Right now, it is now the biggest thing. The second is you're mixing and matching timelines. At the time, the commission was very concerned that issuers might manipulate the table around equity, and so they were very, very prescriptive on what year you show equity. And so equity is when you grant it, period, nonstop. Cash is for what period did you earn it for? And if you think about it, you know, those of us who get bonuses, we get them after the year is over. But that's still, so my bonus for 24 got paid in 25, that's still on the 24 line. If I got equity, which it didn't, would be great if I had, that would be actually in the 25 line item. You wouldn't see it yet, you'd see it next year. And so you have different times and different things. And I think, you know, could you fix it? That's sort of what the comment is about. And I love what you said about what do people actually use. So when you look at board materials, every comp committee has a target table, right? This is what the salary was supposed to be. This was our target bonus. This is what we plan. This is what we plan to grant. Everyone has a target, and almost everyone has an outcome table, right? This is what you got. Like those are things that boards use. And similarly, we now have right, more than a decade of experience with Say on Pay and PSUs and these tables, and you're like, well, what do people put in their CDNA all the time? Because it's not in the summary comp table, not in the required table. And the answer is, well, everyone has a target table. You always see it, right? And everyone has an outcome table. They even have a separate table of, by the way, this is what happened on my PSUs from way back when you forgot about. And so I think that if we didn't ask the summary compensation table to do so much, and instead use the pieces that management and boards use when they think, so a target table, an outcome table, you might not need a whole lot more. And for me, to answer your question on people, fewer is better. I think everyone agrees on CEO that she's stuck with it. I think we could coalesce around CFO, given the original purpose of it, of making sure that position was sufficiently robust and had sufficient stature to support the certification requirements. Everything else is just super interesting. Like, it's just super fun to read. And I don't think the SEC should be in that business. And so, yeah, that's what I would suggest.
One of the things that, and I'm turning to Drew for this, one of the things that we heard today multiple times is the interest in equity, is the interest in how equity is disclosed. And by the way, there was at least in panel one, there was a conversation around less versus more. I think we need to reframe it a bit, like Mark suggested and like Ron suggested. It's not really less versus more. It's perhaps different. Maybe if we could put our mindset around just what's, the reason we're all having these discussions, and no one has said, and I don't think anybody here is going to say that the current system works. So perhaps we should focus on different instead of less versus more. And that would be a really big push on the equity comp side, because equity is complicated. Not only are there different types of awards, there's sort of life cycles of those awards, grant or awarded, then vested or earned, then it paid, maybe vested is paid, maybe it isn't. And then maybe eventually it actually turns into something that could actually buy you something, right? So, but that's a decision maybe the executive makes. So going to Drew, who spent a lot of time, I keep mentioning how much time you spent, Drew. Maybe you should tell people what you told me about the number of hours you spent on reading people's proxies. What do we do with this equity comp disclosure?
Yeah, thanks. So one of the things I do, and I liked what Mark said, and I think it built on something Terry said, One of the things as an investor I'm trying to understand is what is the value transfer opportunity the board is making for this individual. And so, Mark, I think you talked about it in that, what the board is using. And so for me to triangulate on that number, I use the summary comp table, I use the Form 4 disclosures to try to say, okay, what was the stuff we just paid? What is the opportunity that we know at T0, concept investors use today? I know it's a little murky, it's not perfect, might be a Black-Scholes or a Monte Carlo simulation to get at that number, but it's a starting point. And then I think Ola talked about it in the earlier panel, and I know John has addressed this, how do we track some of this over time? And so my biggest gripe today is to get at that value transfer number, especially with the overuse of PSUs. That number doesn't have to be disclosed for about 14 months, right? You don't have to do a Form 4. No, very few people do a press release about that one. And it's not in the proxy statement I'm reading of the most recent grant. That'll come next year's proxy statement. So what I do is I adjust down, and I look at a 5-year, and I bring the equity piece down. I try to suss through the Form 4s. So I spend a lot of time trying to put this whole thing together. So it's not, as you said, less or more, but could we get at the answer we're looking for, which I think both Mark and Terry talked about, is the board made a decision of value transfer. How do we communicate that to shareholders in the most effective way?
And John, you and I spoke about how you all look at comp disclosure to make that useful to you, which was not, I start with the CD&A and just go down. And whether or not the supplemental tables that companies are providing, realized pay, realizable pay, realized pay being the value vested and paid, and realizable being the opportunity, potential comp, is that useful? Why are companies doing that? And when they do that, is that useful to you? And how are you looking at it?
Sure. I'll answer those in reverse order. First, those supplemental disclosures are often really, really helpful, helping us look through compensation through the eyes of the board and not through the eyes of the required disclosure often helps give us a different view into what they're thinking about pay. And we use those, we look at those. That is a fantastic disclosure. In fact, if we're looking at a CD&A and one of those is provided, that's probably, if not the first, very close to one of the first things we look at. Back to your first question, which is how do we actually look at a CD&A? I'm going to disappoint all of the issuers in the room that spend so much time putting 40 pages of text together. We don't start with the text, and I'm sorry to tell all of you that. The current system of disclosure is flawed, but it's what we have, and we've learned to operate within it. And it's difficult and it's cumbersome, but we've learned to do it, much like Drew going through the Form 4s and through all the disclosures to piece together things. That's kind of what we do. When we look at a CD&A, the first thing we do is we look at that summary compensation table to try to get a feel for how are things changing over time. But we know that's not enough by itself. You have to read that, of course, in concert with its footnotes, but immediately go to the grants of plan-based awards table, generally the table right after that, and try to understand, okay, the summary compensation table for the short-term incentive Mark was talking about before, it tells you how much was paid, but it doesn't tell you what was the target. You have to go to a second table to see what was the target. And then sometimes the company's granted long-term cash awards. Long-term equity awards go into the summary compensation table when they're granted, but long-term cash awards don't. There's a disconnect there, so you have to go look at that second table for information there. So you piece together the tables to get a good idea of that first target table, as Mark called it. What did they intend to pay? And then you have to go through and piece together the output table, and that's actually what we're doing also. And some of that's easy to do. The short-term incentive, usually that's reported in the grants of plan-based awards table. Others aren't easy to do. It takes an awful lot of work to go through. And that's what we try to do also, trying to compare the target and the output to see how did the program operate during the year, and is it reasonable given how the company performed on behalf of our clients, the actual end beneficiaries of that investment. After we've done all of that work, then we go look to see if there's a chair letter, then we go read the summary of the compensation table, and then we go to other sources to try to pull out information that we think is material. So we've learned how to use the regime we have, but it's a very cumbersome and inefficient regime to use.
I think I would say that issuers have also learned to work within the regime that we have, which is one of the reasons we provide the supplemental tables. And one of the reasons that I think issuers continue to say that we pay to recruit, retain, motivate, incentivize, even though maybe we could just have a template and everybody says check, and no, we could maybe spare everybody at least 10 pages of that. But we have also done the same. Before we leave the topic of the summary comp table, if anybody has any other. Yes, absolutely.
So what's moved me earlier, Ola, Peter, you said that you wanted a life cycle of those outstanding equity awards, and I 100% agree. I think the three tables that we have currently, we have the outstanding equity table, the grants of plan-based awards table, and the stock vested options exercise table. They're all duplicative, and I personally struggle. Oh, is this option that was exercised, what award does that go back to here? And oh, let me see if I can find the Form 4, and I'm navigating through a haystack. And it's hard, but it would be really easy with a life cycle that reconciles, this is what was outstanding at the beginning of the year. This is anything that new that was granted and the fair value then. This is what vested during the year. And this is what's outstanding at the end of the year, grant by grant by grant, all the way through. And it would solve that maze that you're going through, number one. And then number two, I think leveraging technology could make it a lot easier too, because you could hyperlink to every Form 4 or 8K to really kind of document that life cycle throughout there.
And with that we could segue into the other compensation tables, the grant of plan-based awards table, outstanding equity awards table, the option exercise and stock vest table, the pension table, the non-qualified deferred comp table, the potential payments upon change in control, which isn't a table required but often is. So that we're already exhausted, right? And I didn't even write anything. That's just a long list of tables. So we're just going to lump them together and start with, we've heard that investors don't want repetitious information. What do these tables do, Ron and Mark, that what is the value? Are they repetitious of other things, and what can we do to avoid that?
So the problem is they're repetitious but incomplete, right? And so because they're reporting, you have the outstanding equity awards table that has options on a grant-by-grant basis, but RSUs are not required to be on a grant-by-grant basis. And then, as Terry was saying, in the option exercise table, it doesn't necessarily tie that back to which options got exercised. There's different reporting on performance-based awards. We have performance-based awards that are vested, earned at the end of the year, but none of them actually pay out until once several months later, once you've actually calculated what performance is. And so I think these other tables, once you kind of figure out the basic way to disclose compensation, and I'm a huge fan of Mark's approach of, what's the total target and then what's the earned, and then let's fill in the gaps. You're really kind of doing away with a lot of these other tables. On the outstanding equity awards table, it may be helpful in showing kind of what an executive's overall stake is in the company, but the table itself requires a lot more information and calculations than just conveying that information. And then the change of control and severance table, as you said, not required to be a table, typically is, just has a lot of hypothetical information that, again, I think it's what was referred to earlier of, generating a lot of information that solely goes into the table. The company doesn't really use that for any other information. I think investors are rarely looking at it, or if they're looking at it, they're really only looking at what is the CEO getting, or what did someone, actually get when they did separate.
So we heard from panel 2, and
Can
I
I
think.
just add to
absolutely.
that? Which I 100% agree with you, Ron. I guess I have 2 caveats. Caveat number 1 is, in my universe, I would not be giving every investor everything that they want. Right? My world of disclosure will leave you unsatisfied, because I don't think you need that.
No rum raisin ice cream.
Yeah, right. Sorry, you have to bring your own rum. And the second is on the termination table, if we decide to keep it, it suffers from that normative opinionated disclosure, in the sense that what it discloses is only what you get in certain circumstances. It doesn't disclose what you lose. So if you're sort of if you actually are interested in how does this program keep people in place, and how is it fair, you're just looking at one side of you could imagine fair programs where you don't get much when you leave and you don't lose much. And you could also imagine fair programs where, if you leave, you get a lot. I mean, if you get fired, you get a lot. But if you just leave, you lose a lot. Those are you could imagine those. You just don't see that at all in that table, and it's just something that I always think about.
And in the lead up to the next question, I just want to focus on something Mark said, that we're not, I don't think the securities laws intend us to give every investor everything that investor wants. And that is, we don't do that in any other disclosure that I'm aware of. We're not required to do that. So I think fundamentally we still have to tie it back to the reasonable investor and the concept of materiality that I asked Sarah about. And again, giving you the softball question, Sarah, there is a cost to everything. Every dollar counts. I think that was used 2 different ways on the other panel. Every dollar counts from the company's perspective as well as the investor's perspective. They're actually different dollars. From the company's perspective, Sarah, what can we do to make this both meaningful to the reasonable investor and focus on materiality, and not as resource intensive, costly? I heard the words unwieldy, expensive, scary. I think Zach did a great job outlining all of that for especially the vast majority of companies, which are small and mid-cap. What can we do to streamline this?
Yeah, I think if we're thinking specifically about the supplemental table, so the laundry list that you just walked us through, I'm brought back to something that John said earlier, which was that the supplemental disclosures, where companies describe how they look at compensation through the eyes of the board, is very useful. That says a lot. If what we're saying is that it's the voluntary disclosures that are the most useful. Listen, I know that change can be scary, and I recognize that everyone in this room has likely become an expert with dealing with the complexity that we currently have. But that doesn't make it good, and I think we all are acknowledging that in one way or another. I think on the company side, to come back to something that you said really at the beginning, Ning, it is bizarre to me as a securities lawyer that our teams spend more than half their time putting a proxy statement together that is, I became a disclosure lawyer because I fell in love with disclosure. I fell in love with the corporate story. That more than half of that is compensation related, and clearly more than half of the effort, I would say, for most issuers goes into compiling supplemental tables and information about individuals other than the CEO and the CFO. I'm confused a little bit myself sometimes about how we've sort of gotten to the disclosure lasagna that we now have with respect to executive compensation. So I think reducing the repetition and removing some of the unnecessary complexity that really doesn't go to material decision-making, I think is key.
And does anyone else want to make any comments about the other tables before we move off that?
Yeah, just real quick, and I just want to remind folks that we do want to get to some simplicity here, but the reason we focus so much on this issue is how soon we forget the bankruptcies of 2001, 2002, the great financial crisis. For those of us that manage money or were in charge of overseeing that, our pensioners were furious with us. If you were on the asset management side, your clients were furious with you for not paying attention to the people that were entrusted, right? We're the principals, they're the agents, that the agents did such a poor job in the amount of drawdown in the financial crisis for those pension funds. So are these $20, $30 million paychecks material to a company that's doing $200 billion in sales? Probably not. But it is material when those things fail. And as I said earlier, much of what we invest in is index or index adjacent. And that's why these disclosures are here. Can we do a better job with them? Can we make them more streamlined and more usable? Absolutely. I don't think anybody has disagreed with this. But if we forget the lessons that we learned in the last 25 years about this, when we see failures and drawdowns, they're really hurtful to people, and they're hurtful to the people I oversee for our pension fund. And so be careful here, whatever we do, that this makes sense and we don't lose the tools we need to hold people accountable. These events will happen again.
And actually, that's an amazing segue, because those events led to the next set of rules we're going to talk about, which is the Dodd-Frank rulemaking. And we'll start with the cost of them as well, going back to you, Sarah. Because, yes, they're required by statute, so they cannot completely, at this time, be eliminated, removed. But there was discretion. I think it was mentioned that the commission had discretion in how they were executed, how they were, what the rulemaking looked like. And none of the rules that we ended up with are exactly what the statute required. There is more in every element. And that more has translated into what some people call compliance costs, what I would just call, frankly, just costs. Because compliance costs, to me, a lot of compliance costs are necessary. They're important. They're fundamental to a good corporate, being a good corporate citizen, because they have benefits. But when there are costs associated with compliance with rules that bring, like, what is the behavior that it's trying to accomplish? What is the compliance element other than here's a rule and we just need to do it?
Yeah, just briefly, because I know we're probably coming to less time with our panel, but I think how most boards that I've worked with, at least over the course of my career, how they think about executive compensation is really as a tool of corporate strategy and of strategic implementation. And I think if what investors are after is to understand compensation through the eyes of the board, I think a more principles-based approach provides companies with the ability to be more direct, to be less repetitive, to be less responsive to every single request for every piece of information to be in every single part, right? I think a more principles-based approach, where possible, understanding that the underlying congressional mandates are themselves prescriptive in certain areas, but to focus on board decision-making and how boards are thinking about how to move the company forward strategically and how compensation works to make that happen. And then also something that is interesting to me, that it isn't always, it's now often included, but we haven't focused on it a lot on these panels, which is a discussion of how investors' views are reflected, are solicited and reflected in the compensation program as well.
And to that point, some of the complexity we've seen, I think a lot of issuers would say it's been responsive to specific things investors ask for. That is a whole other topic, frankly, but that going to what Drew, you mentioned about how pay design has become complicated. There are other investors, not you, I know, who have asked for some of those things. And staying with you, Drew, let's first talk about pay ratio. How do you use it? What's the value to you?
So I'm going to be rum raisin here. So in the beginning, and we know why the disclosure is put in place. More recently, my team and I have started looking at the original 2018 disclosures of the median dollar amount that the company disclosed. We adjust it for inflation and look at the most recent disclosures, and we see how that number has changed. Now, I know it's a very blunt instrument, but we've done this a couple of times, especially with companies with, I'll say, high, low-wage workforces, and try to do some comparisons. We try to get real like to like. And one thing we've noticed is companies that are having more worker unrest are the ones that have seen either a flat or, in one case, we saw a decrease in the median amount, quite a significant one. And so are we making say pay decisions on that? No, but it is driving some really interesting engagements for us. And now we're not doing it at every company or every industry. Some industries that median number's quite high. But I do want our boards to think about that bottom 50% of the people that work for them, because in my 40 pages that I read on the plane down, there was a half a page talking about the lowest paid workers. And I think we could spend a little more time, because when I go into a business, I'm probably interacting with a lower wage worker. And if we're going to drive value over time, that's the face of your companies. And so that's how we're using it. I know it's not the way people intended it to be used, but we're finding some utility in it.
True, I'd 100% agree with you. I have no love lost for the CEO pay ratio, but it certainly can't be used to compare company A to company B. Where it can be of utility, I think, is to see how it's changed over time. Last year to this year, unfortunately, the disclosure only shows this is this year's number. It doesn't show last year or the year before or the year before. It would be much more compelling, I think, to investors to show multiple years how it's changed over time, to the extent that the median employee has changed more or less than the CEO, and that would tell more of the human capital narrative.
And this is my point. I have to go back 6 years of proxies, and I'll build a little table. And I think if companies did this themselves, some of them might be actually surprised with what they find. We were.
I think of all the Dodd-Frank rulemaking, the one that has probably inspired the most passion is the pay versus performance table, which I would argue is a little bit of a misnomer, misnamed. Ani and I have spent many times talking about why did they name it that. But so I'll start with Terry, but I also want others to weigh in on the pay versus performance table. Maybe some of you could actually speak to what the statute actually require versus where we are ended up today, and whether John and Drew actually use it and how you use it, and what some of the issuers and their outside counsel grapple with when putting this together.
So I got on my soapbox a little bit earlier. I think people have probably heard my bias that I really liked the theoretical calculation. Unfortunately, the table as a whole became really long and really hard for people to analyze. So where do I think there's utility? Where do you think, my personal opinion is I would love it with only 4 columns. Here's the summary comp table numbers. Here's the compensation actually paid, which is that number I really like. Here's the TSR, and here's the peer TSR, and end it there. And I don't feel a utility in the average of the other named executive officers. I think that is skewing and it's noise. The other named executive officers come in and out, and there's terminations and new hires. So I feel like that's noise. I don't feel a utility to have net income in there, GAAP net income. I don't feel a utility in the company selected measure. I don't feel a utility in these charts. There's all these charts that just all are standard and templated and don't tell a story. So
So I go back to Mark, his comments earlier about the output table. You know, the output table on compensation. In theory, the pay versus performance disclosure held and holds a lot of promise, but the execution, I think, is where we have issues. You know, the question we're trying to answer when we're looking at compensation programs and where we hoped this pay versus performance table would help us is to understand how did prior year performance actually affect pay, or what was the outcome of a program. In 2022, you disclosed that your target pay for the CEO was $10 million. After all was said and done, after the short-term incentive paid out, after the performance share units, you know, reached the end of their performance cycle and we determined what the outcome was going to be in terms of the number of shares paid, when the share price increased or decreased at the end of that program, when all the awards vested, what was that program actually worth? And how did that compare to how shareholders fared over that period? If the $10 million that was granted in 2022 was worth $15 million when all was said and done and the share price was up 10%, 15, 20%, maybe that's good. But knowing that connection from input to output, from target to outcome, I think is where we thought there was a lot of promise. But in the execution of that table, where tranches from multiple years are all molded together, and you can actually end up in some cases with negative compensation actually paid, when I don't know any CEOs that actually paid to work at their company over a year, you know, that disclosure just doesn't work in its current format for the purposes that we really need it to, although there's a lot of promise in the concept.
Yeah. And the negative compensation actually paid is obviously something you get a million questions on, like what does that mean? How? And you know, it's math, number one. Number two, there's probably ways to avoid it by, if we wanted to spread change over a requisite service period, use accounting things. But it's really just math, and maybe it goes to maybe just a tragic name that we had up front called compensation actually paid, and maybe if we had a better name, like change in realizable pay or something, that would alleviate some of the problems and the emotional arguments.
Yeah.
The only problem with that is that compensation actually paid is what the statute said it's supposed to be reporting. So.
Yeah, I hear you.
Yeah. I mean, it would be great if we could have that table and it showed in 2023, we told you the CEO was paid $10 million. At the end of 2023, it was actually worth 12. The share price was up. And at the end of 2024, it was only worth $9 million. By the way, the share price was down. And at the end of 2025, when all was said and done, most programs 3 years in nature, it was worth whatever it's worth. But being able to track those changes over time, super helpful.
Well, what I think would be beautiful, to that life cycle table that you showed that reconciles the beginning of the year to the end of the year, you could put the beginning of year fair value at the beginning, end of year fair value, and see that delta record by record by record.
So, John, to your point about no executive thinks they're working for negative pay, I'll just tell one story before we pivot to our last topic, which is clawback. So in 2006, when I put this disclosure together for the very first time for a very large U.S. public company as an in-house lawyer, we were going to be one of the very first S&P 500 proxy to be disclosed. We were actually in the Wall Street Journal, the very first company to be reported in the Wall Street Journal. So you can imagine the pressure that was on. But the most daunting thing was after putting the disclosure together, I then had to go to each executive and explain their pay to them. And I can tell you that the numbers that I showed them did not represent in the slightest what they thought they were getting paid. So at that point in time, that was, I thought, well, this is why I became a disclosure lawyer. But going to your point about, well, the pay should either or should both ideally represent not only the board and committee's decision, but also what the executive actually thinks they're getting paid. Now, so to the point about clawbacks, which we'll end with, there was a comment in panel 2 that even my mother understands clawback because you shouldn't be paid for what you didn't get. Well, that is a great notion, is that's how the clawback rule actually works. The issue, that we can talk about is the statute said that's essentially perhaps what the statute said, but the actual rule goes beyond that and covers off a lot of errors or different types of things that might have led to a different pay outcome that then we are now dealing with in terms of actually clawing back. So if Mark and Ron, to the extent that you have experience with actually trying to implement the clawback rule as it currently stands, we could talk a little bit about that as we wrap up.
Well, unfortunately, for better or worse, I probably clawed back more money than anyone in America. But I've never implemented this particular rule, which is just an absolute travesty. And I'm really sorry to say that. I've worked with lots and lots of executives, and like someone's grandmother, they're totally okay with the concept, right? Like I have not talked to an executive who was like, well, if I got paid and we restated and it turns out that I didn't hit my metric, I shouldn't get that. Like actually, like this is, business people understand that. The rule, which redefines restatement to be something that's not a restatement, right? So that you have to call it little r, like the fact that there's actually such a thing. The fact that there's like a whole calculus to figure out what you got extra is like this could have been so easy. Of all of these, people would have agreed on it, and in real restatements, which I guess I have to say, in real restatements, it would have provided actual recovery. Could have been great. And we have lots of experience, and other companies have different clawbacks. Nobody, and I guess that's my litmus test, nobody, not like anyone who went and tried to do their own clawback because they feel like it's appropriate for their company to go beyond this rule, no one ever did this. This is not something anybody did.
I'll just join in on that. I mean, this is one that really differs from every other rule we've talked about today, because it's not simply a disclosure rule. It is it's a rule that has consequences when it is invoked, and has consequences even when it's not invoked. The chilling effect on executives and on the design of executive compensation programs, from the threat that something may 3 years down the road be taken back from someone who had no involvement at all with the financial statements, is real. And I think it's an area where, again, no offense to the SEC, but they really went way past what the legislation called for. The legislation actually says that each company should develop and implement a policy, but what the SEC adopted was each company shall implement this specific policy. And so there's no accommodation to how does this work for the compensation program, how does it work for the industry, and because it has real consequences, I agree with the earlier panel that we haven't seen the full effects yet, but I don't think it's appropriate to wait for that train wreck to happen before we try to get the rule, in better shape.
And to wrap up on that point, I mean, we've been talking a lot about how the comp we're disclosing doesn't match the decision-making. And if we were to execute the clawback as currently written, it probably doesn't even match the intent of the rule, which is to make sure that the people who made meaningful mistakes don't get paid. We'll probably end up harming a lot of people. That probably wasn't even in the intent. So one reason that it's probably not as high up on people's radar is because it is very early. But the train wreck that Ron mentioned is inevitable based on the way the rule is written. We just haven't seen it yet because people haven't had the experience yet. but it is definitely coming, and it's going to hurt some people that I don't think anybody in this room wants to hurt.
Well, and hurt companies and their investors if executives are leaving, if they are retiring early because they're not going to pay back the comp and they're going to fight it. And frankly, there's aspects of the rule that will hurt both the company and the investors, because many companies will end up having to advance their executives the legal fees to defend the attempt for the clawback, and may even be required to indemnify them. I know the SEC adopting release said no indemnification, but this is a company policy. This is not a law that is requiring the clawback. It's a company policy, and state law indemnification, we'll have to see. It will be another big fight, but, could prevail over that. And so it's, it's not going to get money back into the pockets of the shareholders. And as you said, it's not going to drive the type of conduct that really should be driven.
So on that cheery note, I will say that I hope that no one thinks that the massively wonderful security that we've all been subject to is a perk to any of us. And I do want to wrap up and thank this amazing panel and all the other panels and all the audience sitting in this room who stayed with us. Really appreciate that support. And thank you very much, especially to the SEC, for hosting this roundtable.
Thank you, everyone, for joining. If you have not submitted a comment, please do so. If you have submitted a comment and the insightful conversation today made you think about something else, please send another one. We look forward to engaging with all of you. Thank you.